All right. We are ready to rock and roll. Make sure. Perfect. All right. People are coming on in. Here they come flowing in. I want to say welcome, everyone. Thanks for joining us tonight. We've got a very special guest in the virtual house tonight. We have Mr. Bill Pilkington, a good friend, CPA for all of our properties, all my personal taxes. So we're excited to have him. We're going to talk about something that I think everybody loves, and that's taxes, right? People love to talk about taxes because they want to know, how can I avoid paying Uncle Sam as little as possible, right? It's not about how much you make, it's about how much you keep. So I'm really excited for tonight to have Bill in the house. He's going to talk about some changes that we've seen this year in the tax code and how you, as a passive investor, can really take advantage of the opportunity out there to work with a qualified tax professional. So, a lot of people that I talk to, especially new first time passive investors, they're always asking me about K1s and taxes. And the first question I ask is, do you have a CPA that knows real estate? And a lot of times the answer is no. And I would argue, and Bill would know the question, and he'll probably talk a little bit about this tonight. Might come up. I mean, they might be leaving some meat on the bone or some money on the table, so to speak. Uncle Sam might be taking too big of a piece of the pie, right? So I think it's really important that you find yourself a qualified a tax professional, somebody like Bill, who knows the real estate code, knows how to take advantage of those real estate benefits that you get, whether you're in the single family space or in the multifamily space, whether you're an active investor or you're a passive investor. So we're going to talk about a lot of that stuff tonight. But before Bill takes over, if you want the slides, shoot me a text this number. I'll get them from Bill. We can share them with you. Bill said they won't make sense unless you hear them from him. So you can definitely watch the recording. But if you want the slides, let me know. And then, of course, quick disclaimer, this is just for educational purposes. We have no solicitations here. We're not selling any investment advice. And we always advise that you consult your own tax professional. If you don't have a tax professional, I highly recommend Bill. He does a great job. His team does a great job. But if you already have one, of course, consult them before making any investment decisions. If you're on this webinar, you probably know who I am and who we are. But if not, it's your first time here, I want to say welcome. My name is Brian. I'm the Director of Investor Relations here at Headway Capital. Our firm was designed to build and protect the wealth of busy professionals who are looking to grow their wealth, to get cash flow, to get equity, to get tax benefits by investing passively in commercial real estate so they can ultimately achieve their goal of financial independence. We have a lot of experience doing that. We've been doing it since about 2018. We've done over 40 syndications, 40 transactions, and still manage a very large active portfolio. We are vertically integrated. Our company was founded by Sid Shamim and his lovely wife, Anam Omer, back in 2017. They've been investing in real estate since 2011, did a lot of single families before that, and eventually graduated into multifamily. And my story, I got into real estate back in 2017 as well in the single family space, eventually grew into multifamily in 2020 and have been doing that ever since. And I have the pleasure of speaking to all of our investors and pointing them in the direction of Bill when they have a complicated tax question. So that's my job. And then Mr. Umar Nakvi on here, he's our CIO, CFO, to make sure that all of our deals are performing and our numbers look really solid. He's a guy who loves spreadsheets. If you don't know us, these are some numbers just about our team. We have over 456 million of assets under management, over 3,000 units. Over 500 investors have actively invested with us, and we target 25 to 30% average returns. And I won't bore you with these testimonials, but we have lots of investors. And these are the types of deals that we like to do. We've got a mixed bag here. We've got some older 1970s product. Watermelon is off of Westheimer in Houston. And we've got two newer products here in Houston as well. So we're always looking at opportunities to find good value. It's not always about how old or how new it is, but we want to make sure there's a value add component. So with all that being said, I'm going to stop sharing. I kind of sped through that because I want to make sure Bill has time and I don't steal his thunder. I want to welcome Mr. Bill Pilkington to our webinar.
Hey, Brian, thanks. How you doing?
Good, good. Living the dream.
Hey, so yeah, welcome everybody. We're going to talk a little bit about 2024. We'll talk about 2025. I don't know what everybody's got on their minds. So at the end, if you have questions, we can kind of go over them, pretty much answer. Well, I can definitely answer no matter what you ask. It's just that the answer might be, I don't know. So we're happy to take what you can, but whatever we can do. Most people kind of tend to have the same questions. So if you're thinking it, there's probably two or three people, others that are thinking the same thing. But as we kind of start to get into it here, we will just kind of go over some of the changes. Let's see.
Yeah, and if anybody has any questions, please put them in the Q&A box. We'll take those at the end.
Yeah. So IRS, it's not really that bad. They actually do have a set of rules they're supposed to follow. They fall under what the Congress actually sets all the rules for them. So they often get a bad name, but they do have a set of rules. It's just that, like any game, the rules, you got to know somebody that knows the rules. So that's where we spend a lot of our time. I like to, live in the real estate world, invest myself passively, and so just kind of help you navigate through the things they're going. And it's like, I don't know about y'all, but I'm kind of like, where did 2024 go? It's like we're already in 2025. And we're already in February, and February is going to be over in a couple of days. So as we kind of go through these things, maybe they'll kind of jar your memory. At the end, I'll leave some contact information. You have questions for a follow up there, but let's go ahead and get started here. One of the biggest questions I usually get, it's related to the bonus depreciation and how they're able to write these things off. Now understand one thing. The way the bonus depreciation works, it's for a portion of the asset. And it is getting smaller every year. This year, 2025, the amount that we can write off is 40%. Now that's based on when the asset was acquired. So if you acquired an asset, i.e. like multifamily, single family, during calendar year 2024, the number was 60%. 2023, it was 80. 2022 was 100. So there's actually even still ways, if you've never taken bonus depreciation, if you own properties and you had purchased it in 2022 or earlier, you may still be eligible for the bonus depreciation of 100%. Depreciation is another way of just saying, when you buy real estate, how do you get your costs back? You bought these things, how are you going to recover your cost? And they don't matter if you financed it, paid cash, or have, some combination thereof. And so, because a typical multifamily or, single family, actually, they follow the same rules. If you buy a property and the buildings are worth 2.75 million, 275,000, I can do the math in my head with those. What the IRS says is you're allowed to deduct 100,000 per year. So it's kind of like, imagine you had a big log and you put that log on the fire, and that fire will then burn the log down evenly for 27.5 years. So the same heat would come off for 27.5 years. Actually, say 27.5 hours. With bonus depreciation, what we do is we saw that log in half, and then we cut it into little pieces. It's actually what they call like cost segregation, when they start to take half of it or a portion of it and cut it into smaller pieces. And then some of those pieces might burn in 5 hours, 7 hours, 15, but that last half of the log, it's still going to take 27 and a half hours. And that's still that rule's there. It's there now. It'll be there forever. The 5, 7, 15, that hasn't changed. What changed was the bonus. Bonus is a lot like throwing a bunch of lighter fluid on those little pieces and burning them all up. Well, 3 years ago, they would burn them all up in the first year. 4 years ago, then it goes to 80, 60. This year, those pieces you cut up, 40% of those pieces will burn up this first year, and then the rest of them will spread out over the 5, 7, 15 years. But a lot of people have come up to me and they're like, well, I heard Congress is going to change it, or now that Trump is in there, they're going to change it. They're going to go back and they're going to fix 2024. We're going to get all that. It's going to go back to 100%. Yeah, that train sailed. It's gone. 2024, they're not changing the depreciation. They're not going to go back to 100% bonus. Maybe they did in 2025, but if you're waiting to file your taxes for 2024 because you're waiting, hoping they're going to change the law from 2024, they're not. That train has left the station. So you are left now with 2024 having to think about, what did you do? Again, so did you buy single family? Did you buy into a multifamily? Did you sell some of your investments? Were you self-employed? Did you have, some type of real estate business? Were you just a W-2 earner? You know, it's time to start thinking about what did you do last year? How did you get income? What did you spend money on? Because you've got now like about 6 weeks to file your return. 3 if you're a business, a partnership, or an S corporation. So time now is to start gathering those receipts, start putting them together, whether you're doing your return yourself or if you have another professional working on it. You want to start putting all those things together, if not already done. Ideally, you were doing them last year. So good tip for this year, it's a whole lot easier to remember what you did over the last 4 weeks than it is over the last 12 months. So start keeping good track of your records. Now, most everybody here, so we're all in Texas, but please understand, not everybody is in Texas, which means you may have invested in a state outside of here. Everybody thinks about the IRS and filing with the IRS taxes, but you may have an obligation to file in one of the other states. So if you invested, could be a commercial deal, could be a car wash, could be a multifamily, maybe you own a single family. You could have invested something outside of Texas. Check to make sure that you may or may not have a filing requirement. So again, it's one of those, you invested in it last year. So, now you may invest in something and it was in Texas and you're going to get a K-1 this year. When I say this year, meaning for 2024, if you haven't already received it. In it, you might find there's actually another state K-1 in there. Don't get too nervous. There are several states that require all of the passive investors to receive a K-1 from that state when one member of the overall partnership is from that state. You're going to notice they're all zeros, and you're going to get questions. And usually what happens is the passive sends back, because we prepare a lot of the K-1s. Hey, my CPA has a question. Why are we filing in New York? Why are we filing in New Jersey, Pennsylvania, Missouri? And if you notice, they're going to be zero. You're not required to file there unless you are from that state. And what happens if you are from that state, now you've got your own individual K-1. It doesn't happen all the time, but just don't all of a sudden assume you have to file in another state. Again, just kind of, check some of the details. But, sometimes people don't realize it's like, hey, was I supposed to be a real estate professional? Was I not supposed to be a real professional? Did I make a mistake in 2023? Did I over deduct something? Did I under deduct something? So best thing is, if just because you may have done it wrong in a prior year, don't let that repeat itself. Get a good pattern, get a good record keeping system. Even if you're only passively invested, you want to keep track of those records. If you are using your IRA money to invest, you also want to keep track of all your K-1s, because the reason you're keeping a lot of these K-1s in how much you invested, how much you've received back, it's going to have a big impact when the deal finally sells, or if your single family sells, commercial, all of these things, they come into play. So you want to make sure you keep all those records through the entire investment period and then for 3 years beyond. So after you sell, you want to make sure you're keeping your records for 3 years after your deal sells. Yeah. Now, we've been kind of talking in general here, but a lot of people, they want to be real estate professionals. They think they're a real estate professional, or they don't know what it is. So the question is, okay, who are you? Like, what do you do? What are your hours? How what do you think it takes to be a real estate professional? What do you know? And we go through a lot of those discussions with the people. But again, that's also something It's a whole lot easier if you plan in advance than trying to recreate something. Because the truth is, when it comes to the IRS, if it's not written, it didn't happen because they're going to ask for the records. They're going to ask for the documentations. Will 100% of you have to provide that? No. Truth is, maybe like 0.1% will get audited, but that's not zero. So, and just because you're not going to get audited doesn't mean you can do things that are not correct. You always want to make sure and file it correct. You always want to make sure your tax returns are being filed and you're not having to worry about it. It's like, okay, I don't want to get audited, but in the event I do, I want to make sure I've got all the documentation, the proof to back it up. Now, with respect to real estate professional, those come with a lot of tax benefits. Passives come with a lot of benefits too. Me, myself, I'm a passive. There's lots of real estate benefits I get out of being a passive. It's the difference tends to be a timing. So the biggest thing, real estate professional, people's like, well, what does it take to be a real estate professional? First thing, it's not only a real estate professional, it's called a real estate professional with active participation. So the real estate professional part, that one means is the majority of your time spent working in a real property trade or business. Are you doing things related to real estate? You could be developing houses. You could be property management. You could be a real estate agent. You could be a construction company. It's, are you working in the real estate field is what you're doing. And if you are, you want to make sure you have at least 750 hours doing that. And it's more than 50% of your work hours. So if it's your only job, 750 is all you got to worry about. But if you have 2 or 3 jobs, I was going to say, okay, what are the total hours you work for all your jobs? It is at least one more hour than half of your time spent in real estate. So kind of another way of saying, if you work another job and you spend 800 hours at that other job, you need to make sure you have 801 in the real estate side. And FYI, I know people can work a lot, but if you're working full time at another place that is not real estate and you're saying, no, but I work 40 hours there and I work another 41 hours, I'm working 80 hours a week, it's very possible. It's also highly likely the IRS is going to audit you. So you kind of really want to make sure, are you really doing it? Now that just puts you in the real estate professional field. The active participation part, meaning the part where then you're allowed to start deducting all of these losses, are you doing the things that people who sign the front of the checks do instead of the back? Are you actively involved in property management? So it's a rental real estate activity. Are you doing the things landlords do? If you own a property and you're doing your own rehab, well, that will come into the 750 hours. Working in the rehab, doing your own work, doing your own gardening, doing your own landscape maintenance, repairs, maintenance, that all falls into the 750. But a landlord, their job is to manage the property, not to do the rehab, not to do the landscaping. That doesn't count towards the 500 hours. The 500 hours are managing the overall property, approving contracts, reviewing financial performance. In the terms of a syndication, it's the stuff the lead investor does. Now, if the lead is talking with a passive, they might both spend 2 hours reviewing the financials. Difference is, though, the lead has the ability to make that decision to what they're going to do with it. The passive doesn't. Those 2 hours count for the lead. They don't count for the passive. So again, it's understanding what you are doing when it comes to the real estate and what role you're taking on. So it's first 750 hours just in the general real estate field, but then 500 hours of active property management. Now, question a lot of people say is like, well, how's the IRS going to know? What documentation, what proof do I need? And so usually what I say is, okay, if you had an employee and that employee, you hired them to do real estate work for you, what would you want that person to give you to convince you to write that check and pay them for their time? Is it just going to be their verbal representation? Hey, I worked 20 hours this week, cut me a check. Is it a piece of paper that says, I certify I worked 20 hours, cut me a check? Probably not. You're probably going to want some sort of better timesheet, some type of description as to what they did. Again, if you're having to pay them, what's it going to take to convince you to give your money to them? That same documentation, well, now it's like you got to give it to the IRS. The IRS is going to be asking you, what did you actually do? You can't just say I spent 100 hours doing this. They're going to want to know, were you walking the property? Were you checking your comp rates? Were you checking different mortgages, seeing what you could get? Were you out trying to raise capital, promoting your deal, finding tenants? All of those things, as you get more specific, that's going to be your proof that you've been spending the time to do all these real estate related activities. Now, all that being said, that's if you're trying to go for the real estate professional status with active participation. Now, why do people do that? Because that way, if they experience losses, tax losses, many times again, we go back to that depreciation. We're just accelerating the deductions. One log over 27 and a half hours, or cut it in half and start burning it up in 1 hour. At the end of the day, it's still the same log. The timing difference of when you get to experience the heat from that log is much like being the real estate professional. The timing is, I'm going to deduct these deductions today. I'm going to offset my real estate income, my real estate losses against my job. Maybe I cashed out of an IRA in order to buy into this deal. Maybe I, did something else along those lines. I sold some different things. So you want to be able to use those losses today. For most of the rest of us as passive investors, we still eventually get those deductions. It's just that those real estate deductions, what they are, they're typically held behind glass, and the glass says break in case of profits. You don't lose the deductions. You just have to wait until you have passive income. So if one of your deals sells and it has a large gain, before you pay any tax on that gain, you have to first recover all of your losses. So what does that mean? If you're in 5 deals and each one of those deals has a loss for tax purposes of $20,000, collectively, that's $100,000 worth of losses. If one of your deals sells and that one deal has a gain of 60,000, well, you had 5, one of them sells, and that did have a 20,000 loss. Well, you use that, but you had 60 of gains, so you still have 40,000 of gains. You're just going to take 10,000 from each of those and use them to offset your gain as well. So now the year it sells, that 60,000 gain, you're not paying any tax on it. Now, at one time you had 100 worth of losses, you just used up 60, so you've only got 40 to go forward. But for the time value of money, you just got to use all those gains. And if you go ahead and reinvest that into deal number 6, that deal number 6 is probably going to reduce your income again. It's going to create new passive activity losses. Those losses will be able to offset more future income. So again, we get to kind of defer. and I usually defer, defer, die. Dying is not really our number one real estate strategy, but last time I checked, other than Jesus and Mary, one out of every one people died. And actually, Jesus died too. But so that's where we kind of go with those. Now, that's why it's being a passive, being a professional. Sometimes it's not always better to be the other one. Sometimes it's good to be a passive. Sometimes there are many benefits because you're preserving yourself able to start getting the cash flow. And because understand, like, once you start getting that, at that point, it's not that you're reducing your current income, you're able to increase your cash flow with no increase in tax. Now, there was one thing I know I just talked about how if you built up these losses and then you sell it again, but maybe you only had like one property, one investment, and it sells at a large gain early in the year. Or you've got a single family and you're looking to sell. People often want to do what's called a 1031 exchange. It's like, okay, instead of selling, I'm going to take this property and I'm going to trade it for that property. That's a very good strategy, but it's not the only way you have to do it. So, and it doesn't work if you're invested in another deal. It works if you are the one on the title. If you're the one that owns the property, you are able to swap those. But it doesn't mean that you're out of options. In the event that, say, you've got these gains, or maybe again that same 5 deals, you had the 100,000, but it's got 150,000 gain. You're going to use up all that loss and still have 50,000 worth of gains. So a strategy that we often use, it's called a lazy 1031. What a lazy 1031 means, if you have gains, you have that calendar year to try to offset the gains. So if you pick up a gain in January, if you're able to get into another deal or buy your own property, could be an IRO, could be a single family, or get into another passive deal. And if that other passive deal is able to generate losses, and it could be, you could have sold single family, large gain, you buy into a car dealership. You could have sold a car dealership at a car wash at a large loss, and you buy into a multifamily. As long as they're passive deals, the losses that are generated from that other deal, and FYI, that deal could have closed on December 31st. It actually happened to a couple deals. People got into it. They closed on December 31st. They're going to be able to take a lot of the depreciation and recognize for tax purposes a large loss. That will allow you to defer, again, more gains into the future. No tax on your gains. You get to keep pushing them forward. Now, everybody's kind of like, I know I keep talking about like the deals are giving you gains, giving you losses. Maybe we kind of like want to recap again. When you're in a deal, the deal itself is typically taxed as an LLC, and then that LLC files a tax return as a partnership. So that partnership doesn't really pay tax. It distributes all the money out to the investors. So if the investor is going to own 10% of the deal, then like it's like a spaghetti colander. Their hole just happens to be 10% of it. If they own 1%, they've got a smaller hole. Someone with 15 is a bigger hole. Everybody is getting the same gain or loss, just proportionate to their ownership. And so what we kind of do is, again, so as this water is coming out, again, it could be hot water, it could be cold water. You're able to offset one property from another. You're able to pour the losses or gain from one and offset it with another. The IRS is going to look at you holistically, provided it's not in an IRA. IRAs are like their own separate person. We're talking about non-IRA investments. And so gains from one can be offset with gains, losses from the other. Now, many times people, they kind of wonder like, okay, so if, how do I know if I have a gain or loss? If I'm looking at these K1s that get sent out, what's like just maybe a good base for me to start? So if you go to your K1 and you look down on the Schedule L partner capital account. Now, this is looking in the rearview mirror, but as you look on your last year's K1, the thing that says ending capital account, start there. That's your number. And if your deal sells, any extra amount, any cash you receive, the difference between that cash and that number on the ending capital, that's a pretty good indication of what your gain is going to be. It is very possible your capital count is negative, and that's okay. Because what the IRS will say is, okay, your capital, i.e. your cash invested, you may have taken more expenses or you may have gotten more distributions out from the deal than you put in. Go up a little bit higher to the section K, kilo, and that's going to show you, okay, of the deal, go up a little higher to section J. What percent do you own? What percent profit and loss do you recognize? Those percentages up top come back down to K multiplied by the total debt, i.e. the mortgage or maybe property taxes payable, accounts payable. The way a partnership works is they kind of say that's like you get to share in the mortgage. You get to share and you leverage that mortgage. Not always, but many times you get to leverage that. And so that's what's allowing you to get paid distributions that are more than what you put in, yet you're still not paying tax. Now, not paying tax today. The tax does come due. These cash that's getting paid out to you are like a advance on a paycheck. One day the bill does come due. But what happens is if you are negative, again, say it's negative 20,000 and you receive a check when it sells for 30,000. That means your gain is 50,000. But that's because you've got these losses that were built up from the prior. And some of y'all may be thinking like, well, how do I know what my losses are? I see the negative, but I don't remember how much losses do I have, or maybe how much room do I have before I have to start paying tax? Another form, this one gets filed with your tax return. It's the form 8582. So when you look at this on page 1, there on line number 2D delta, that is going to tell you your number. So if that says minus 300,000, if it says 300,000 worth of losses, what that's telling you is, hey, the first 300,000 of gains or income, first 300,000, no tax. That's only recovering the losses that you've already incurred for deals from the past. So kind of like when I use my example, the 5, they came to 100,000. In that example, line 2 would say 100,000. And then so this kind of gives you also a gauge, because say something sells and you're in March, April, May, and your lead is telling you, hey, looks like we're going to sell. Looks like your share is going to be 100,000 a gain. And you're like, oh my God, am I going to have to pay tax on that? Do I need to buy something new? What am I doing? Or they think you're going to be there, but October they're thinking, but they don't know it might close in December. FYI, just like I said, if you get into a deal that closes in December, if the deal you're in closes in December, you could have a gain for the year, even though you may not get cash until the next year. So come back to your 8582 and kind of figure out, hey, can I absorb that much of a gain? Do I need to buy into something else now? Do I need to start worrying about that now, preparing for taxes now? Also, deals sometimes, again, they could be a value play or a yield play. Value plays tend to get a lot more deductions, and because they're going to get their gain on the back end. If you're sitting on 400,000 worth of losses on your 85, 82, maybe you don't have to keep going into value play. Maybe now you're like, I can start going into yield play. I can start going on things that are going to be turning out profits really fast because I don't have to worry about the taxes. I've got this much built up. And it doesn't matter if it's a short term or a long term gain. Until you recover that entire number on two, you're not paying any tax. So it kind of helps you maybe decide where you have the choice to invest. But do understand the clock is ticking every day. The clock to get into a new investment, the clock to file your taxes. And sometimes if you wait too long, it's too late. Kind of like when I said that, train has left the station. Not a whole lot we can do for 2024 other than make sure you're properly classified. Going back to look like, did I qualify as a real estate professional? Did I not? Did I buy into these deals? A lot of what we're doing for 2024 right now is just making sure they file and they're compliant. We've got a little bit more play, like if you have your own business and you're self-employed, maybe you still want to put some money away from retirement. You want to put it into like a self-directed 401k plan and then use that 401k to invest in somebody else's deal. Okay, we still have some play there, but for a lot of passives, it's you can't get into a deal. You can't backdate it. It's like I can't bet the Eagles are going to beat the Chiefs on Monday morning. And so we can start looking forward to 2025 and start thinking about, okay, what do you want to do? Try to make your crystal ball a little more clear. But what we're looking for is, again, get it done early, because the earlier we take care of your 2024 taxes, and I say you could do them by yourself. You could have an excellent CPA on your side that understands it. And some CPAs, the problem is it's not that they're too conservative, like they didn't give you all the deductions. Sometimes the opposite. They actually give you the deductions you're not entitled to. Because if we kind of go back to that thing, like the Form 8582, the losses, if you're a passive investor, you are not going to be able to use those losses to offset your W-2 income because you're a passive. That's the way it's designed. And if you are taking those deductions against your ordinary income, it is possible the IRS comes back a couple of years later and says, oh yeah, by the way, you weren't allowed to take those deductions. And so now you owe us the tax back plus interest plus penalty for underreporting your income. So it actually, sometimes it's not that they don't get all the right deductions. It's that they maybe don't want to tell you, or they feel good because they're going to tell you you're going to get this nice big refund. And so unfortunately, sometimes my rule, what I have to do is tell people like, no, you're not going to be able to take those losses. I know you cashed out of your IRA and you use that money to buy into these deals, but they're independent things. Just because you cash out of an IRA and use all that money to fund a deal, you don't get to take the losses from the deal. Just like if you work at a job and you get a paycheck and you use your money from the paycheck to buy into the deal, you don't get to offset those. But that's not a bad thing. I do that. What it means is you're now building up a bank of losses. And so when these deals sell in the future, now you've got all your records. You've been keeping good track of all the money you've spent, everything you've done. When it does sell at a gain, you're not worried about taxes in the future because, hey, I got this covered. I've been doing my planning in advance. I knew one day I was going to sell this at a gain. I'm ready for that. In fact, actually, I've been able to live off the cash flow, take this cash flow, and this gain I get, now I'm going to reinvest it so that I'm not going to pay taxes for the next couple of years. And you get to keep extending it out. But that's most of what I got. A little bit high level. Some of y'all may have some specific questions. We can go over them now. If you want to set up an appointment, we can, talk. I will tell you right now for 2024, we're actually full. So we can get an extension for you. We can, try to do like a very high level, but again, let's not repeat the, same things from before. For 2025, we can start getting a plan to start doing your tax planning, forecasting. We can file your 2024. If you got a great CPA or a tax preparer and they're treating you right, they're getting the things good, you've got a good relationship, you don't have any reason to change. I'm not saying you have to change. It's very possible you got a good one. But if all you're doing is they tell you in springtime, send me your stuff, they just send you back your taxes and they're like, all right, I'll see you next January. Maybe you want to develop a relationship with somebody else who's going to be there to help hold your hand along the way, someone who's going to help answer questions and sometimes give you the answers that maybe it's not what you want to hear, but it's what you need to know. But with that, Brian, we'll kind of turn it back there and
Yeah, no, awesome. Leave your stuff up on this, your contact information up on the screen, Bill. If anybody has any questions, please put them in the Q&A box. We're happy to answer any questions, particularly about tax code. And obviously, if you have something more private and intimate and you want to schedule a call with Bill, reach out to Juan. He'll get you on Bill's schedule and make sure you guys get to chat. Bill's a wealth of knowledge. And what I like about you, Bill, is KISS. You keep it stupid simple because taxes can be very hard to understand, right? It's almost like you're speaking a different language sometimes. And I don't think I've ever gotten off the phone with you and been like confused, so which I can't say is for everyone, right? So I appreciate that about you. Keep it simple. So if anybody has a question, and don't be afraid to ask, we're here to help. We're getting a lot of thank yous, so appreciate that. Bill, I have a question, just something I'm kind of curious about. You talked a lot about the depreciation, and I think that's like a hot topic. Everybody wants to know about the depreciation. What are some other things that maybe you're keeping an eye on that maybe you didn't talk about tonight that you're looking forward to seeing if, new administration changes that could either hurt investors or benefit investors? Or just some things maybe that are in the works that we should be on the lookout for?
So some of the things we're looking at is so while depreciation is the big one, interest.
Mm,
Well, just remembering, like him or don't like him, Trump was a real estate guy.
sure.
Trump's now president, like him or don't like him. So he's going to start directing Congress of things that he wants to do. He's the one that helped get a lot of the bonus depreciation go through the past. Most likely, 2025, I can see them bringing back a lot of the bonus depreciation. I can see them start bringing those things back, not for 2024, but for 2025. So seeing
Mm,
some of the depreciation, they're looking to try to bring down the interest. So again, making it easier, freeing up the money, start making it more sensible to either buy a property or if you're currently in something, refinancing it. The last 4 years have seen just interest rates spike largely due to inflation. So they're looking at those. This is more like, as crazy as it sounds, like on a state by state level, some states were putting such the squeeze on insurance companies that where they weren't able to raise the rates. And so some of those insurance companies are maybe leaving the states. California is a very big one.
mhm.
Well, insurance companies can only take so many losses.
Sure.
And if they're losing in one state, they're probably, even though they're regulated, they may start having to raise rates. I think everybody here is probably seeing some of the insurance just go crazy.
Yep. Yep.
Uh, if some of these companies are able to then get what is fair in some of the states that have been holding them back, they may not have to squeeze out the other states quite so hard.
Mm,
So that's helping there. And then finally, as a lot of these, now that energy is starting to come back up, Texas, again, a lot of our stuff's going to be in Texas. Well, Texas is going to get a lot of money from oil and gas reserves. A lot of this money, then, if that is going in to fill the state's budget, they're going to start reducing property taxes,
mm,
which means, again, so one of the costs of operating real estate is going to be, well, one, energy, and then two, the property taxes. You start seeing some of those things start coming down, but you don't have to reduce your rents. In fact, actually, still raise the rents. You should always be raising them because you're producing a good product. Your profit, your NOI begins to increase. As your NOI begins to increase, a huge multiple as to what the value of the property is. And so, again, so as investors, that's just going to exponentially increase their return on the investment.
That's awesome. No, that's good stuff. I never, that's interesting. The taxes and insurance, or I call them, I mean, debt is another one, but taxes and insurance usually kill deals.
Oh yeah, it's like
Most of the time. I mean,
hidden
obviously,
killer. Yeah.
yeah, I mean, especially in Texas, right? I mean, obviously, if you overpay and you have the wrong debt, that's going to always kill every deal. But taxes and insurance here are crazy. So that's really interesting. I'll be keeping an eye on that. The other one I was curious about more of your opinion on, and I don't necessarily it'll affect anybody in the short term. We're seeing a lot of cuts from Doge, right? A lot of I'm reading articles about IRS agents getting laid off, and everybody was talking about how Biden brought on 80, it was like 88,000 new IRS agents or something in the last 18 months, and it was freaking everyone out that there's going to be more audits. Now we saw basically with the swift of just a swipe of a hand, they basically got laid off. And people are talking also about like AI kind of coming in because of technology being able to audit things. Do you see that changing
Oh
the
yeah.
business this year? And if not this year, how do you think maybe that might impact things going forward when it comes to just taxes and auditing and things of that nature?
So they may, we're talking about 72,000 agents. Okay, if they're not going to hire 72,000 agents, they're going to employ 72,000 terabytes of information of AI to start putting these things together. And all of a sudden, you're invested in a couple of deals, your social security number is out there, these things are out there, and they start linking which ones are together. It's going to be a computer that is going
Mhm.
to be able to determine, okay, does this person have another job somewhere else? How many hours are they working? How many properties they have? Are they really a real estate professional? And it is very possible they are, and the computers gets it wrong. But look for some of these things to start picking up on them, and now the letters start going out to the people. I mean, Trump's talking about all these tax cuts. He's no dummy. He's gonna find the money somewhere else. There's
Sure,
gonna be some of the low hanging fruit, and if a computer then can go through and with all the database start matching things up, okay, what these people are invested in, what they're not invested in, I think they're going to start going after some people maybe that were, you know, they had two single family homes and they want to call themselves like real estate professionals with active. It is
right,
possible they spend 750 hours and 500 hours on it.
sure,
But man, if someone's spending that much time, they need to talk to you because they're doing it wrong.
yeah.
It's
They're
like,
painting with the smallest brush in the world. I don't know.
yes.
It,
I
yeah,
mean, cutting the glass, cutting their grass with toenail clippers or something. It's like, yeah,
yeah,
maybe you did, but that's not the best use of your time.
right,
Again, don't let the tax tail wag the dog. Deductions are good as a real estate professional, but if you do it the other way, it's like, okay, maybe I'm not going to save my money today, but it's like, I'm not paying taxes on the future cash flow. And, it's like kind of like I've heard it said before, it's like, if you got a tax problem, you ain't got a tax problem, you got a cash flow problem. And
mm,
so don't let the taxes file them correctly, do them right, but don't be so paranoid that you have to change everything else you do.
that makes sense. Makes sense. Yeah, it's really interesting stuff. Everyone's talking about AI and leveraging that. And I'm curious, and that makes total sense, right? It's gonna allow them to hit a lot of low hanging fruit, yeah, because they can start connecting different things. SEC stuff gets filed, and then the IRS can connect to it, and it's gonna get much easier, I think, to catch people that are doing things wrong or low hanging fruit. And I also think there's that first wave is probably it's probably going to catch a lot of things that maybe were just filed incorrectly, like human error, right? It's a lot of human error. I mean, we're all human beings. You hit the wrong key on the wrong keyboard or whatever. Somebody selects the wrong box, and before you know it, there's something going on. You're getting audited, and it's just like, oh wait, this is just human error.
Yeah.
So
The other thing, my experience has been like, even in the audits. So if you've been keeping your records all along and you've got good documentation for everything you did, and like, so nobody wants that letter. They get the, letter of death from the IRS. Your return's been pulled for an audit. My experience has been like, you contact them right away. You're like, yeah, let's go and get this done. And you
mhm,
come up there and you show and you've got your A game on. And you're like, yep, here's my documentation for ABCDE. And you make their job easy. They're going to like, you're going to go through about 4 or 5 things, go, yeah, this guy's got his stuff together, done, no change. You
right,
mess around, you fumble it, you don't have this, you don't have that, you delay, you reschedule. They're going to be like sharks in the water, man. They smell blood and they're just going to keep going and going and going. And
right.
so they've got a large list of things to do. If you can make their job easier, they're going to be like, yeah, nothing to see. Let's move on.
Right, right. That makes sense. That makes sense. Good. It's a good reminder. Nobody likes keeping documents, whether digital or paper, but you got a CYA, and if you're
Yeah.
not covering your butt, so to
Yeah.
speak,
And
you
you,
never.
and Actually, you just said digital is fine. You don't have to have the originals. It's
Yep,
I scan mine and save them because you can
me
scan and you
too.
can save forever.
Yep.
Because things fade. Houston, we get floods.
Yeah,
Whatever.
I have a tax folder, and I have years 2020, 2021, whatever, and I keep all my tax documents. I scan because a lot of companies will mail you stuff, right? It's old school.
Yeah,
And I'm like, I'm not keeping this in a drawer somewhere in a filing cabinet or a shoebox. I'm going to scan it. I'm going to throw it in the trash, shred it, right?
yeah.
And I just keep documents that way. So that's a good practice, I think.
But don't be afraid to take legitimate deductions. It's not saying
Sure.
shy away for fear of it. It's just if you go into, just go in it with eyes wide open, knowing what you're doing. Say, yeah, I've got the documentation for this. Everything's good.
Absolutely, absolutely. Well, Bill, I definitely appreciate your wisdom and advice. This has been awesome. I think I got a lot of thank yous in the chat. Hopefully, you'll get some calls scheduled. If anybody has any questions, reach out to Bill. If you have any, if you need a referral or you want to hear from me on how my experience has been, Bill's been great to work with. I'm just saying it now. So, team's very responsive, fairly priced too. A lot of firms charge an arm and a leg to get their taxes done. You've always been reasonably priced, so definitely appreciate that
Well, thank you.
as well. And yeah, I'm excited to see you grow. I know over the last few years, you've gotten quite the number of clients. It's exciting to hear you say you're full. So that's awesome news for your
Yeah.
business. So congratulations.
All right. Well, hey, thanks. I appreciate your time.
Yeah, thanks everyone. Appreciate everyone joining tonight. We do these webinars once a month. So if you're not attending these webinars and getting educated, you're missing out. So if you're watching the recording, try to show up live. Looking forward to seeing everyone next month. I hope everyone has a great night. Appreciate it, Bill. Thank you.
Hey, cheers.